Tyler, we have been on another wild ride with oil prices over the past few years. You go back to the pandemic. Remember when oil prices actually went negative? Futures went negative. We adjust that to a more viewable level, and oil prices have just skyrocketed in the past few years. But the story of 2023 largely has been a story of oil price volatility and lower oil prices than we saw for much of the couple of years right before. You ready to talk about oil prices in 2024, our expectations, and maybe some stocks investors might want to consider?
Oh, it's always fun to talk about oil, maybe a little reckless prediction, all the things you like to do heading into the new year.
Yeah, and I'm glad you said reckless predictions because we're going to make some predictions about what we think oil prices are going to do, but we're also going to talk about companies that you might want to consider investing in that they should be okay kind of no matter what oil prices do. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. Okay, Tyler, our background, a lot of folks watching this might not know, but you and I both have been covering the oil and gas industry since 2012, 2013, really. So over the past decade, we've seen a massive amount of change. One thing I think is worth mentioning is one of the changes that we've seen is that $70 oil in 2023 and 2024 is very profitable for just about everybody. And in 2014, almost nobody outside of OPEC was making money anymore at $70 oil, right?
Yeah, $70 oil back in 2014 when shale it was taking off, right? It was this boom time where they had figured it out. They learned how to produce a lot of oil, but they hadn't quite learned how to produce it profitably. And so, yeah, in 2014, a lot of companies, when you would read their investor presentations, it was like, oh yeah, we're super profitable. But at a time where we had 5 or 6 straight years of $100 oil, that sounded fine.
That was the context, right? Because oil really from 2010 or so through mid 2014, I think it was July 2014, started coming down, was consistently above $100 for that period of time.
Yeah, booming shale production in the United States, coupled with some places like Iraq really bringing its production back online. A couple other global major producers, Nigeria, Algeria, were starting to get stuff back together after some bad years. And you threw these all together, and all of a sudden, we just realized, holy cow, we've got a lot of oil coming to market. And we had the crash in 2014 into 2016, 2017. And it's why oil prices were so low for much of the 2010s, because so much production had been brought online in a relatively short amount of years. And once you get it producing, you don't really want to turn it off because it's still bringing money in the door. With all of that in mind, the mid 2010s, we started to see a recovery the end of 2019, but then we had COVID hit and all of a sudden global demand fell through the floor. And that's where we got negative oil price.
That's the thing that created the boom that we saw in 2022, right? Early 2022, when oil prices hit 120, is because so much oil got shut in during the late first quarter and the early second quarter of 2020. And guess what? The global economy opened back up really quickly, and turning that production back on took a lot longer than it did our ability to consume the oil that we had in storage.
Yeah. And then, but on the cost side, because like you said, companies nowadays, they talk about, oh yeah, we're profitable at 30, we're profitable at 4, some even saying like $25 a barrel. It's because like that 20 to 2020 period was like the Rocky montage movies of him training, where it was just like these guys just sweating.
The shale industry getting fit and learning how to make money at $30 and $40 oil.
It was just thick to swole really fast. And today we have a much, much better, more profitable industry. And even though we've had volatile oil prices for, let's face it, oil prices are volatile every year. When's the last time we were like, oh yeah, that was a pretty modest year? Despite the volatility, companies have, almost all oil companies, at least the ones that I have been tracking, have stayed generously profitable for much of 2023. We talk about companies like ExxonMobil throwing off more or less record cash flows because of investments in downstream, very profitable upstream operations, and things like that. And so we head into 2024, at least from a oil business perspective, I think in a really good place. From a price perspective, I don't know. One of the reasons we started.
Let's do that. This is a perfect time to pivot to our predictions. And again, I want to stress this. Tyler and I both follow the oil industry quite closely. We follow the global energy industry quite closely. And anybody else in that industry, our predictions, the process is good. The process of making predictions and plans is useful, but the actual prediction itself is almost always useless in terms of its accuracy, right? So the first thing you said, you've already made one prediction, and that's the state of the oil industry. It does seem to be relatively healthy, right? So thinking about the global direction of oil prices is still largely set by the Middle East, particularly crude oil. OPEC Plus still sets the market. It really does. These are the global leaders in production and also costs, right? Some of those assets that are in play can produce at close to single digit dollar prices. They can get the oil out of the ground. Then there's some cost to get it to the market that you add on to that, but it's the cheapest oil in the world. And they can produce massive quantities of it relatively quickly. So that is a reality that sets the market. The US, Tyler, has become the swing producer. Shale can be brought online. You can add production relatively quickly. You can bring production off relatively quickly. You just stop drilling wells, right? And production declines pretty quickly. So those are the kind of things that have factored into setting the market broadly. And then there's the main thing that affects oil prices, Tyler, and that's the global economy, right? The demand itself. We talked about supply, but the demand is what drives it. And if we think about the global economy, it seems relatively okay. There's continued talk about recession as a possibility, but we aren't talking about a global pandemic, a global financial crisis. We're talking about somebody on a bike that's been pedaling really hard for a long time that's just going to cruise a little bit and slow down, right? The normal cycle of the economy, maybe just taking a breather.
So the International Energy Agency put out their most recent kind of 2024 demand forecast, and they're expecting 2023 to add about 1.1 million barrels per day to global demand. That would
about 1%, right?
A little less than 1% because it puts us at 8 million barrels per day in global demand. So just to give some perspective, though, that's less than half than the amount of demand that was added in 2023. We're probably going to end the year at about 2.3 million barrels per day higher in terms of global demand. Weaker than anticipated growth in Europe. European economy has not been growing as fast as the United States in this higher interest rate environment. Talking about weakness in Russia for a myriad of reasons between the Russia-Ukraine conflict and other things. Middle East looking weaker. We've talked in other videos about the slowing Chinese economy and some, especially related to like real estate and construction there. And so outside of the United States, there's a lot of just tepid demand. Like you said, nothing looks like it's heading into deep recession, but no one's really like shooting the lights out of it either. And so with modest demand, we could see modest demand like that. And you still got barrels of oil that are going to hit the market. Offshore production facilities are going to go online. For example, ExxonMobil's got its projects in Guyana. That's expected to add a lot. Mm-hmm. Brazil has a lot of production that is expecting to come online in its offshore fields, which have been very productive, very lucrative places to do it. And I don't want to go too far on the limb, but there are some things that would line up that suggest that we're probably not headed for 3-digit oil prices. But then again, nobody really thought that either in 22. And then all of a sudden we had a major power invade another country, and all of a sudden we were looking at $120 a barrel. That's the thing with oil prices. We can talk about all we want and try to set broad strokes about what in global demand, but geopolitical events can basically throw that on its head at any given moment. We're already seeing a couple things now about terrorist attacks in the Red Sea, which would impact global oil trade. And so there's things like that you can't predict. There's no way you can like even remotely have an idea of what's going to happen 6 months, 9 months from now. What's more important is just invest in the companies that can be profitable with a margin of safety. Basically, like the oil market were to go very south, these companies are still going to be profitable.
Took the words out of my mouth, and I would build onto that, Tyler, the thinking long term, because again, the cycle can turn quickly. Oil prices can move really fast in ways that we were not expecting them to, and it can destroy capital quickly. And if you're just responding to the stock price because oil prices went down and you're selling out of that, you're probably missing opportunities. Usually when the prices are going down, that's usually when it's time to be buying, not time to be selling. So with that in mind, the stock that you want to talk about, I think it's the ideal hold through every market environment. I want to go first because I do want to talk about a stock price that if oil prices go up is probably going to be a really big winner. And that's Devon Energy. So for people that don't know, Devon Energy is an independent oil and gas producer. The stock price has come down. I'm looking right now to see how much is it down from its recent high. And it's down 43% since the beginning of 21 from the high point in 2021. And I'm going to share a chart here because I think this chart perfectly shows why owning producers can be wonderful and can also be bad. And that's essentially because what this stock is going to probably mostly do is what oil prices do, Tyler. The purple line is Devon Energy. The orange and blue are West Texas and Brent crude spot prices. And that means that the stock price is largely going to be a leveraged bet on oil prices. Now, there's more to it than that, because that's just the stock price. That doesn't show the total return, which includes the dividend. It's one of the reasons I think that Devon is interesting right now. I'm going to bring up their presentation, their most recent presentation. I believe they did it in November when they reported their third quarter earnings. The first thing is it shows, we talked about margin of safety. And what they show is their free cash flow yield at different levels of West Texas crude. So you see $70 West Texas crude, they're going to generate 8% free cash flow yield. That's pretty decent cash flow yield at oil prices where they basically are now. And then it shows at 80 and 90 how that free cash flow yield can increase, not just the percentage, but in terms of dollars. They're making a couple $2 billion a year at $70 West Texas. That doubles, right? That doubles if we were to get to $90 oil prices again. That if is the question, right? So that's where you have to be careful. The other part of it that I like is, again, that variable dividend. They have a base dividend that's very low, that's sustainable at oil prices much lower than this. I think they can probably break even on a cash basis, $40 or $50 on the majority of their output, and they can support that base dividend. And then their variable dividend, they grew at a pretty substantial amount in the third quarter because they had better realized returns on the oil that they sold. And what that means is, again, if oil prices do move higher, your stock price is going to go up, and they're also going to pay a large amount of the free cash flow that they generate. They're going to pay in that variable dividend they pay out to shareholders. So if you think oil prices are going to go up, I would say Devon would be probably one of the smarter bets, because the prices come down, and we haven't seen with some of them, like the super majors, like the Exxon Mobils of the world, their prices really haven't come down to the same degree because the market's pretty optimistic on those businesses. Let's talk about one that I own, that you own, that is rock solid across any market. They're going to make their money no matter what oil prices do, and the stock price generally is going to reflect that.
Yeah, so the company I'm going to mention, because Jason told me not to go too weird and obscure and, I don't know, give some oil services company based out of Namibia or something like that. So I went with Enterprise Products Partners. They're a midstream company, which basically means pipelines, transportation, petrochemical manufacturing, some crude oil export terminals, basically the things that move the product and get it where it needs to go and take a fee to do it. It is one of the largest midstream companies in North America. They specialize mostly in natural gas liquids, which is very much correlated to shale production because it's a very light crude that throws off a lot of natural gas liquids in production. And the reason that I wanted to focus in on this one specifically, at least from a investor's perspective right now, is it's not a high growth company. So I think a lot of people would kind of turn their nose at it. But right now it has a forward yield, basically like the expected yield over the next 12 months of 7.8%. And ever since the company started trading back in 1998, it's had an average yield of 6%. So we're about 1.5% dividend yield premium to what it has traded historically over the past 25 years. Post-COVID in 2020, there was almost like what would you call it, like a stepwise change in how the market has viewed this business in terms of yield, where basically it's been vacillating between 7.5 and 8%, which is much, much higher than anything historically. Part of that is because there's not a lot of investment opportunities in midstream and infrastructure in North America right now. It's more or less pay a very generous dividend, grow it at 3, maybe 4% annually, and maybe buy back just a little bit of stock, keep your debt without having to add any leverage because you're not spending anything. And all of a sudden that adds up into a 10, 11% realized, yield or return, if you will, on that company. And it's like football. Take the points. It's not going to swing with oil prices. If oil prices significantly decline from here, you're probably not going to see a huge movement in its stock price or its dividend. And similarly, if oil prices go to the moon, you're probably going to get what you're getting right now. So it's just a down the plate, down the fairway sort of investment where you're not trying to do too much, but you're getting exposure to the fact that oil and gas demand is going to be around for a while. And this company is going to pay you pretty generously in the process.